European markets have been taking direct hits following the resignation of British Prime Minister Liz Truss. Truss announced her decision Thursday after just 44 days in office. It follows weeks of political and economic turmoil in the UK, triggered by her controversial tax-cutting plan. Her economic agenda was scrapped earlier this week by her own newly appointed Finance Minister, Jeremy Hunt, who executed the move to stabilize British markets. For more on this, let's bring in Akin Oyedele, who's the investing deputy director at Business Insider. Akin, thanks for being with us. What's the political instability in the UK doing to the European markets?
It's definitely causing turmoil, especially if you consider that European markets closed lower today on a day when U.S. markets sort of shrugged off a lot of what was happening elsewhere in the world and domestically and closed higher. It's been a rocky ride, to say the least. We've seen the pound fall to a record low against the U.S. dollar as a result of Liz Truss's policies and some of the fallout from that. We've seen the costs to the U.S. government, to the UK government, rather, borrowing costs spike in terms of interest rates. And this has had knock-on effects on mortgage rates and all sorts of other parts of the economy over there.
Right now, UK inflation is just over 10%, and that's even higher than what we're experiencing in this country. What's behind it?
A couple of things, but you could say mainly the Russia-Ukraine conflict. Because that has boosted food and energy prices, not just in that region, but globally, but particularly over there, where the cost of things like milk and eggs and bread and really consumer staples that everyday people use regularly, those things are a lot more expensive. And, both countries make up about a quarter of wheat and barley exports globally. So instability definitely hampers the level of supplies, and that's why we're seeing a spike in prices.
So what you're saying in simple terms is that the supply chain being desynced by the war is especially hard on the British with, basic foods and goods.
That's correct. And,
okay.
That's correct.
Okay, so the European Central Bank meets next week. Are you expecting another big rate increase?
Yes, markets widely are expecting about a 75 basis point increase. It's interesting because this is the first time this year that the ECB is unlikely to shock the markets with a big rate hike. It's managed to really guide expectations this time around. And so we're expecting 75 basis points and probably another 50 or 75 in December. Of course, they're doing this to fight inflation and do whatever it is that they can to bring inflation under control.
I don't need to tell you this. You know that the European markets really had a terrible week, right? With virtually all of the major indexes down. But, here in the U.S. on Friday, the markets really had a big up day. The S&P 500 rose nearly 3%. So what explains this kind of disconnect or the erratic behavior of the market?
Sure. So you're correct. There was a pretty stark disconnect today, especially between U.S. and European markets. And this week overall, I think, part of what's helping U.S. markets is we're starting to see quarterly earnings roll in. And a lot of these earnings are not as bad as Wall Street had feared. And in an environment like this, any good news is really good news. There's also a sense that perhaps we had overcorrected to the downside. And so what we're seeing is just some sort of a rebound. And we often see these big rebounds during bear markets because what tends to happen is that people get too afraid and then they realize they got too afraid. So then they try to correct. And so that volatility is really a hallmark of a bear market. And that's part of what we're seeing in the U.S.
And then these massive investment funds that come in blocks really can play havoc with the markets, especially if you're an individual investor. Akin Oyedele, please come back soon. Thank you.
Thank you for having me.